Okay, I'm very sorry for the typo that you just saw, because we have already indicated that normally um, the lease payments, or I mean the lease liability and the row, the right of use assets, they're normally not much different. Okay, and uh, their fair values are almost the same, all right? Uh, I mean, their amounts are usually almost the same. All right, so there was 450 or 80,000, which was something not comparable with the fair value of the asset. Okay, the fair value of the asset, which was actually 1.2 million. So it couldn't be compared and it couldn't be comparable, right? So that's why I said it was a type. And in the examination, the examiner is normally not going to tell you the present value of the lease payment. This one is too artificial, right? In the examination, you need to compute it yourself. But how do you compute it? We say that this is a present value, right? So obviously you would need a discount factor, uh, which discount factors to use, or a discount rate. But because this is not a financial management examination, usually the examiner so it is going to give you an annuity factor, all right, because normally in leases the installments are going to be of the same value. For example, in this case the annual installments are going to be 250 per year. So they are going to be constant cash flow, so they are an annuity, and you'll be given an annuity factor for 5 years, right? And they've given us 4.329. So to compute the lease liability, it's very simple. You're going to just say lease payments, where you, yeah, we are told that they are 250,000, multiply by the discount factor, and we get the lease, the lease liability. All right, then we compute a row, because I said immediately when you enter into a leaseback transaction, you did recognize and then recognize a row. So the row, there's a formula which we indicated that it's the PV of lease payments divided by the fair value of the asset. Okay, and the fair value of the asset, it was 1.2 million, which was equivalent to the sale proceeds. All right, and the PV of lease payments, as we have computed on step 1, that's 1,082,250. So you then have to divide that by the fair value of asset, and you then multiply by the carrying amount of the asset, which was 800,000 from the question, as you can see there, and you are going to get your row. This is the right of use asset you are going to recognize in your records. Then after that, you compute the profit, okay, the profit to be recognized. And I said that you only have to recognize the portion of the asset transferred. The portion of the asset which was transferred. Okay, let me just quote the right word. You need to recognize the proportion relating to the right of use transferred. That's the right wording. Okay, so that right which was transferred, the gain on the disposal, the portion related to that gain which was transferred. All right. So to do that, you first of all have to determine the overall gain. The overall gain on disposal. The overall gain on disposal, well, it should be fair value of the asset, all right, less the carrying amount. Sometimes in the examination, you are going to be given two values: the actual amount which was received and the fair value of the asset. excuse me, there seems to be some background noises. Let me try to locate those ones and correct according. Just 1 minute. Okay, going ahead, ladies and gentlemen, I was saying that for you to compute the total gain on sale, you need to have the fair value of the assets less the carrying amount of that asset. But I've said that in the examination, expect to meet the sale proceeds, the sales value as well as the fair value. And most of the time, students opt for the sales value in the computation of the gain on disposal, which is wrong. Okay, that will be very, very wrong. In this case, we are using the sales value because we are told by the examiner that the sales value is equivalent to the fair value. But the actual formula is fair value less carrying amount, and you obtain the gain on disposal of the former asset in a sales and leaseback transaction. Are we together, ladies and gentlemen? Good. So in this case, what was the fair value? The fair value was 1.2 million, and the carrying amount of the asset, excuse me, was 800,000. Therefore, the profit on disposal was $400,000. Moving on, remember, we want to compute the appropriate gain to be recognized in our records. So, gain relating to the rights retained. This one is an important figure because without it, we are not going to come up with the rightful computation. Okay, so the gain relating to the rights retained is given by the original gain, which we have already computed in the a few minutes ago, a few seconds. This is the gain which we have already computed, the total gain. But we then want to determine the gain relating to the right or to the rights retained. So in this case, the original gain was 400,000, but we need to then determine the proportion of the right retained, and this one is given by the present value of the lease payments over the fair value of the asset, and this we already have these figures, right? And we can see that the figure is 360,750. However, the standard wants us to present or to recognize the gains which are related to the rights which have been transferred as a result of the transaction. Okay, so which means from the overall gain, you only have to account for the gain which is a proportion of the rights transferred. So in that case, we just say the total gain of 400,000 less the gain on the rights retained, and we are going to be left with the gains relating to the rights which have been transferred. That's 39,250. Okay, now step number 4, we then have to record the transactions in the account, the movement, what was happening. Remember, an asset was sold for cash that was 1.2 million. So we are going to debit cash. We are also going to debit the right of use asset. Are we together? Hang on. Somebody's just saying, hang on. We are saying we are sellers, but at the same time we have become lessee. Okay, so because we sold the asset, we want to receive our 1.2 million. Okay, 1.2 million has to be received. Okay, so this is why we are debiting the cash. But at the same time, we are also going to recognize an asset now. We are now tenants. So we are now going to recognize the right of use asset. Am I talking to somebody? Can somebody say amen? Good. Then on the credit side, we are going to derecognize. We are derecognizing the original asset, derecognize the carrying amount of the asset. We are derecognizing it, so it has been derecognized by crediting the 800,000, which was the original carrying amount. Then we have to recognize a lease liability, which we have computed on step 1. Please revisit step 1. And this was the lease liability, the present value of lease payments. And the balancing figure is this one. But in real life, you need to compute this figure. There should be evidence that you have done something. But obviously, we have done it here. This is the computation which we did altogether. So if your debit and credit entries are balancing, then it means you need to clap hands for yourself and say, Mr. Examiner, I'm ready. I'm ready to pass this paper. All right. So how are we going to show these transactions in the financial books? Okay. So in the statement of profit and loss, obviously the gain relating to the rights transferred should be shown. If the examiner says produce the extract statement of profit or loss, obviously he is expecting you to show him or her that that amount. It's very important for a mark. Otherwise, if you fail to come up with that amount, you're going to fail. Then the right of use asset is going to be depreciated like another asset. All right, we are going to do depreciation accounting, and it depends with the question. Like in this case, we are told that this is for 5 years, so we are going to depreciate the asset at the lower of the useful life of the asset or the lease term. Okay, the useful life of the asset or the lease term. All right, lower of useful life and lease term, whichever is lower. That's how we are going to do the depreciation. In this case, we're told that the asset is going to be leased back for 5 years, equivalent to its remaining useful life. All right. There has been a qualification where the examiners, they know that the standard is saying lower of. So he is just trying to simplify the problem for you. Okay, but in SBR, you need to lead yourself. You need to lead yourself to know what is going on. If you are given the useful life, let's say if the useful life was 10 years there, and the lease term is saying 5 years, and you guys are going to depreciate it over 10 years, you're going to fail. So this is a very serious issue. Okay? Better. So the depreciation is also based on this figure. What is that figure? This is the same figure which we said relates to the right of use asset. Okay? And we have computed the right of use in step number 2. That's how you compute your right of use asset. So don't be confused and say, hey, Mr. Akatuta, you're confusing us and so forth. Those are the steps, ladies and gentlemen. And this, like I say, this is an ICU for your emergency recovery. Okay? This is for your emergency recovery. Okay, there's no time. Next week you'll be seated in the exam hall and you mustn't fail. Just replay this video, replay it. Don't mind the grammar, but just enjoy the sense. Because if you say, no, man, the English is very poor, so I don't want to listen, I want to listen to this, those guys are not going to be there. Or maybe they are not lucky to give you what is going to come, right? Maybe this one is going to be tested in the exam. So you will thank me later. Just watch it to the end. So depreciation, we say that this is based on the right of use amount which you have calculated in step number 2, and just take that one and divide by the number of years, and you arrive at this amount. Okay, why is it negative? Yes, depreciation is a cost, so we need to deduct it from the profit. So this is why I've put it in brackets. Then what about the interest? The interest, this one is the finance cost. Finance cost. Remember, we are talking of long-term liabilities. The lease is not for 1 year; it's for many years here, and so there are going to be some interest payments related to the financing facility, all right, relating to the lease. There's going to be some interest charges related to you enjoying. You are enjoying. You have been given a building for many years. All right. So in some way you have been funded. All right. You have been funded. So your lease liability is almost like a loan. Okay. In a sense, it's almost like a loan. It accrues some interest charges. All right. So we're going to use lease table. There's going to be a lease table in computing this interest for interest computations. You see that table, and normally it also depends on whether the installments are going to be paid in advance or in arrears. Okay, in this particular question, what was the instruction? The payments, the annual payments are going to be made in arrears. So the behavior of your lease table or lease liability table is going to be determined by such a term, in arrears. Okay, so this is why I'm saying that you need just to pay very careful attention, because people who fail this paper are very clever people. If you listen to them when they are at a cafeteria or at an eatery, the type of grammar they speak is not of this world, it's out of this world. Something maybe that is found in Trafalgar Square, London. Okay, they are good people who have got good command of English and so forth, but they fail this paper because this is not an English language paper. It's accounting. Are we together? So we just need to chill up. Okay, we just need to chill up and follow the tutor. So let us try to do some workings. Okay, just ignore the first part, the statement of financial position and so forth. All right, let us concentrate on the lease liability. In this case, this is the lease table and I've been talking about. Okay, sometimes it is given horizontally, sometimes you can do it vertically. All right, doesn't matter. You just have to know the principles. You just have to know the principle. So we start with the lease liability as we computed on our first working, and we found this figure. This is the opening balance of the lease liability, and then we use the interest as stipulated in the lease. Okay, the interest implicit in the lease, right? Which was 5%. So we multiply 5% of the lease liability and we get the interest. This is the amount that is charged to the statement of profit or loss as your finance cost. So this is where we obtained the finance cost, and this is why we say that it's subject of the working and you have done it. So those are the three items which have to be found in your statement of profit or loss. If the examiner says, hey, come up with the statement of profit or loss and so forth, those are the three items for an MMA in relation to right of use assets. Okay, in a sales and leaseback transaction, we need the gain on transfer. We also need the depreciation charge and the interest. All right, so you then, if you do that, you can tell yourself that, hey man, I'm not a good accountant. Isn't it so, Mr. Examiner? Yes, I am. Then you clap hands for yourself. You have passed the paper. All right. So you see now, like I said, you need to understand the dynamics. This is an arrears situation. Arrears situation. So we are going to, on the 1st of April, we entered into a sales and leaseback transaction, and then we're going to charge this interest. We have not been told that this interest is prorated, so do not worry about that. Just charge the full interest at 5%, and then at the end of the year, this is now 31st December. Okay, all right. In this case, they're saying, okay, the end of year is not December. Actually, let us look at the question. Okay, so this one is actually 31st March. Okay, that's the end of year because it has started on 1 April. Okay, fine. So actually, those issues to do with rating and so forth, they're out of question. This is a full year question. All right. So the opening was 1st April and the end should be 31st March the next year, that is 2008, and that's when we pay our our annual installment of 250,000. So what I wanted you to see was that the liability started at one point that, but it has been increased by the interest charge, okay, which is then going to be decreased by the the amount then is going to be decreased. That is the amount of the liability, because the liability is increased by the interest which has been charged that year, but it is going only to be reduced. The liability is going to reduce through payment of installments. So when the installment has been paid, we come down to this amount. Thus, the liability carried down as of 31st March 2008 or 20x8. Okay, that is the end of the year. All right, then we then need to do some computations, extra computations, because remember, if you don't do the extra computation, you're going to lie to yourself. You're not going to be able to come up with accurate records. So you need to then compute an extra year. Why do you have to do that? Remember, today is at at the end of the year, that is 31st March 20x8. You need to produce some accounts, because the question is saying produce, what are the amounts to be recognized in the financial statement at the end of 3rd March? At 3rd March 20x8, that is at the end of 20x8. So, for you to come up with the rightful figures, you also need to extend your table by another year. This is going to give you two important figures, the non-current liability as well as the current liability related to this lease transaction. So we then have to say this was the closing as at 31st March 2008, but we need to apply some interest, some 5% interest on that, and this is the interest. All right. So the liability has increased by 44,318 from 886,363 at end of year. So the interest has increased it, but with the installment paid at 31st March 2029, we are going to rest at this much. So which one is our non-current liability and current liability? Obviously, this one, this amount at 31st March 2029 is the non-current liability. Okay? So we recognize that amount at 31st March 2028 as a non-current liability. This is why we have put it there. The examiner would want to see that working. If you dilly-dally and ignore to extend your table and just rest at 31st March 2028, you're going to get a 0. Am I talking to somebody? Good. Now, what about the current liability? The current liability is very simple. You just have to deduct the closing liability as at end of year 2029 from the opening liability, that is the closing liability at 31st March 2028. So it's a matter of this amount minus this amount, and you get your current liability as we have shown here. This is at 31st March 2028, and this one is at 31st March 2029, and you get your current liability. Are we together, ladies and gentlemen? Good. Now, there is one figure I didn't speak about, this amount. Okay? It's debatable. Other textbooks put this amount, the row, but that is wrong. Okay? That is wrong. Why? Because row is subject to depreciation. If you simply put that row amount there and and ignore the impact of depreciation, then you are lost. Okay? You'll be lost. So you need to then deduct the row by the depreciation, and you get the closing balance or the closing carrying amount of row, which would be 577,200. Anyway, this was done to just illustrate the concepts in detail and to help somebody. Somebody has been helped in terms of the lease liability table, and somebody is happy, and I'm sure he's happy, and they are subscribing. Please do not forget to subscribe. Do not forget to share the video with others so that they benefit too. Just like you want to benefit, so help others to benefit too. We also have to make the school known to everyone, because some people do not know that the ACCA tutor is actually available on WhatsApp. Just say hi on his WhatsApp number, +263 774 596 368. That's the number. You understand? That's the number, the Zimbabwean number. Okay, the golden Zimbabwean number. Right. So you just have to contact me there anytime, any day, from whatever destination you will be or whatever location you are. Just don't worry. Just say hi, Mr. ACCA tutor. I've watched one of your videos. I think my kid or myself or my niece, my cousin should study ACCA with you. All right, I'll be very grateful. All right, so guys, let's move on. There is this question. During the year ended 31st December 2024, Billard Company incurred expenditure on two projects. Project A, costs relate to the evaluation of alternatives for improved production systems to be implemented during 2005 and 2006. The company spent 1 million on related salaries and materials and 2 million on design equipment, which had an expected life of 4 years. Project B involves the testing of a new product which will be introduced to the market in 20x5 and is expected to generate profit over a 4-year period. The company spent 4 million on salaries and materials. The policy is to charge a full year's depreciation on assets. Okay, so what is the total charge to profit or loss for the year ended 31st December 2024? Right, so please just pause the video and try this on your own. Okay, hopefully you've done something, because in the examination it's all about showing evidence that you have been practicing questions on your own. If you enter into the examination as a crybaby, somebody who has always been led by somebody to come up with a solution, you're going to be in trouble. Some of these things just need practice. Okay, so let us now do the question together. The question wants you to come up with a charge, the total charge to profit or loss. The total charge. Why did they say total? Because as you can see, each project has got varied cash flows, okay, varied transactions and so forth. And by the fact that there are two projects, obviously when each project could have its own cash flows, which transactions, which would then come up with some total expenditure by the end of the day. Remember, we are told in the introduction that the company incurred expenditures on two projects. So let us be systematic. Let's start with project A. The costs relating, they are relating to alternatives for improved evaluation of alternatives. So you ask yourself, evaluation of alternatives. Are these research expenditure or development expenditure? When we are still evaluating alternatives, obviously we are still doing some research. So in that case, we need to expend the cost. That's research expenditure, isn't it? So being research expenditure, we then ask ourselves, how much was this? And we are told that these guys, they spent 1 million on related salaries and the materials. All right. So obviously the amounts relating to those salaries and materials should be expensed 1 million. But there is an addition. Okay. we are told now there is an end 2 million on design equipment, which had an expected life of 4 years. You know, the wording of the examiner, if you're not careful, you might as well think that the design equipment was also, part of the evaluation of alternatives for improved production systems. But we don't have that evidence. All right, we don't have that evidence based on the facts given by the question. But the evidence we have is that it was also an expenditure. So, but it was an expenditure which was on something that has been developed or that has reached a development stage, because we are also told of an expected life of that. So this particular equipment should qualify, okay, should qualify to be treated as a development cost. All right, so the 2 million is development cost. Okay, however, being a development cost, there is a related charge, which is depreciation. Are we together? Because we are told that even we can qualify, we can capitalize it, okay? But it has got an expected life of 4 years. So which means we need to then depreciate it, that is to allocate its capital expenditure on a systematic basis. So in this case, the related expenditure should be the depreciation cost of 2 million over 4 years. So which means we need to recognize 0.5 million as a cost. Then let's look at project B and see if we can find other cash flows. Project B involves the testing of a new product. Testing of a new product, which will be introduced to the market in 2005. We can see that this is now a new product. Obviously, no more research now. This is developing. It's a development expenditure. Okay, we are talking of a development expenditure. So the whatever expenditure incurred here should be capitalized. However, we are told that this product is going to be introduced in the market in 2005 and is expected to generate profit over a 4-year period. So the company spent 4 million on salaries. All right. Now, yes, they have spent 4 million on salaries, which means this should be the salaries and materials should be capitalized. Okay, their development should be capitalized. All right, and depreciation charge. Okay, the depreciation charge of 4 million over 4 years is equal to what? 1 million per year. All right, the depreciation charge which should be charged should not be allocated. Please get me right. Should not be allocated now. All right. Why? Because we want, the depreciation is only going to be charged in the year in which the asset is going to be used, or is going to, to start to be used. So in this case, the asset is going to be introduced to the market in 2005. So the amortization of this asset should then start in 2005. So this is going to be charged in the statement of profit or loss in 2005 and not in December 2004. So if you add up, you're only going to see that 1.5 should be the charge, the total charge to the statement of profit or loss. Are we together, ladies and gentlemen? So these are the trick bits which I felt you guys should have discovered and replenish your minds with. All right, do we still have an okay, this is the solution, ladies and gentlemen, for those who want to get more information about this. Okay, now a section B question which I felt you guys should enjoy. Okay, you should enjoy this. It's related to IFRS 16 again, and I know IFRS 16 is going to come. All right. If you don't see IFRS 16 in the examination, then that examination was not interesting, isn't it? Okay, so I want you guys to be interested with these things so that by the end of the day, you will be proud that you have been warriors, you have fought a good fight, and you have won it. Okay, on 1 January 2025, Block's company entered into a new lease agreement as follows. Agreement 1. Agreement 1. Agreement 1. This lease relates to a new piece of machinery. The initial measurement of the liability prior to payment of the deposit is 220,000. The agreement requires Block Co. to pay a deposit of 20,000 on 1 January 2025, followed by 5 equal installments of $55,000 starting on 31st December 2025. The implicit rate of interest is 11.65%. Okay, so in the examination, given this scenario or sub-scenarios, you then need to find a question that talks about that particular scenario or agreement. You deal with the question, you go. Okay, because there won't be any time to just go back and forth and so on. You're going to be lost along the way. If you read everything now, you're going to be lost. All right, so deal with each agreement at a time. Right, so let's look at a question relating to this. So I'm sure you have you can even take notes as you be reading the question, like on your notepad or scratch pad. You be writing something, like for example, in this case, the opening lease liability. The opening lease liability. Obviously, we are. It has been initially measured at 220,000 before the deposit. So when we pay the deposit, because we are required to pay the deposit at the start of the year, the deposit is 20,000. So obviously the lease liability, opening lease liability, should be 200,000. That's something you should at least know. You mustn't lose a mark because of that nonsense. Okay. All right. I'm sorry, don't mind my language. I said don't mind my grammar. All right, now that we have established this important thing, we can then come up with our table if need be. But let us be led by the question. According to IFRS 16 leases, which of the following is characteristic of a lease? Okay, you see, there was actually no need to panic. You just have to, be composed, all right, as you attend this question. Number one, ownership of the asset is passed to the lessee by the end of the lease term. Is that a characteristic of a lease? Obviously, no. That's not. It's not obvious that ownership is going to pass to the lessee. Okay, after your lease term, you return the property to the owner. Normally, that's what happens. So it depends with the lease terms. So one is false. Right? Two, the lessor is responsible for the general maintenance and repair of the asset. This one depends on the lease term again, whether it, according to the lessor, is it an operating or finance lease? All right, all those things. All right, so those is also, it depends on the terms of the lease. So which means by elimination, you can see that 2 is wrong. 3, the lessee obtains control over the use of the asset. Yes, this is the characteristic of the of the lease, because remember we recognize a role, a right of use asset, which means that right is linked to the control of the asset, control over the use of the asset. So if the terms do not give you the control power, then that's not a lease. So our answer is 3. Let us see 4. The lease term is for a major part of the useful life of the asset, which is wrong again. Sometimes you can enter into a lease for 2 years for a building that is going to be there for 50 years. So you can see that the answer there is 3. So to get these marks in an examination, it's very, very simple, isn't it? Let's move on. Number 4. For agreement 1, what is the finance cost charged to profit or loss for the year ended 31st December 20x6? Are we together? So just follow the the prompts which I've given you, and the information I have given you so far. Remember, the finance cost is the interest charge, and you need to tell yourself, is this year first year, second year, or third year? All right, so you come back to the scenario. You are told that on 1 January they have ended 1 January 20x5. So by 31st 20x5, 31st December 20x5, that's year 1. Then you then go for year 2. Okay, good. And you also have to establish, was this in a lease in arrears or in advance? In terms of the annual payments. Given the information here, are we paying in arrears or in advance? Ask yourself that question and give me the answer. Okay, I'm very glad we have discovered that this one was actually a lease where installments are going to be made in arrears. Okay, we're going to make a deposit on the 1st of January, but that's not the lease. The lease installment or the annual lease installments. These ones are going to be made starting the 31st December 20x5, which is end of year. All right, so we just follow our lease liability table. All right, where we are going to start with the opening liability. Okay, opening liability, and in this case the opening liability year 1. All right, the opening liability was 200,000. Remember, we adjusted the 220 by deducting the 20, which was the deposit, and we left with the lease liability of $200,000. And we are told that in this year, right, Okay, let us just do it vertically. Let's just do it vertically. All right. The interest is at 11.65%. Right. I'm sure you saw this. 11.65%. All right. So we multiply by the lease liability and we get how much? Now let me use my phone for that. 200,000 multiplied by 0.1165, that's 23,300. Okay, when 23,300. This is year one. Year one is like 20x5. But the question wants the interest charge, the finance cost for 31st December 2023. So those people who picked this one and were complaining in my inbox, they were actually lost. This is just for year one, right? So this one increases the lease liability. However, it is then reduced by, can somebody answer me in my inbox right now? Yes, it is reduced by the lease payments or the annual payment, the installment. The installment at 31st December 20x5 is going to reduce this by how much? 55,000. And we are going to get how much here? It had increased to 223,300, okay, minus 55,000. So we arrived at 168,300. Okay, now we then have to apply, we apply interest again. We apply interest on this, and this is the interest which is required for our answer. 11.56%, 11.65% of 168. 300. That's the interest becomes 19,607. Okay, approximately, through rounding. Okay, so you can safely see that our answer is that one. And if you have been my student, I'm sure you're not going to guess out these simple mathematics, because if you guess, you're going to fail. I bet with my salary, you will fail. So to avoid being a benefactor to the ACCA course, or to be, to be somebody who is a donor. Well, there are some people who are just donating. Every examination, they come out with 42%, 47%, sometimes 32%. Somebody came out with 27%, and I was saying, hey, what happened? And they said, oh, our tutor used to say, no, don't be serious with this exam. Please come to me and pass these examinations. You need to pass 75%, 80%. Those are the normal pass rates for students who have been with the ACCA tutor. Are we together, ladies and gentlemen? So let's move on now. You can see that if you know if it is interest in advance or in arrears, you're home and dry. I will show you the table for the for the for the installments in advance. I'll show you. Don't worry. I'll show you. This is why I have created this video for you, so that when you enter into the exam hall next week, you are going to be somebody with, full of confidence. Let's move on. The following calculations have been prepared for agreement 1. So we are still at agreement 1. So that's the the horizontal presentation of the table we have been talking about all along. How will the finance lease obligation be shown in the statement of financial position as at 31st December 20x7? So we are preparing financial statements for 20x7. But I say you then need to do an extra year, because if you don't do an extra year, you are not going to come up with the figures we need. So it's very simple. This is the 2008 closing figure. This one is our non-current liability. Okay, and for us to get the current liability, we then have to say the closing for 2007, this sum, minus the closing for 2008, and we get the difference should be the current liability. And let us do that one. Let us see. So obviously, in the examination, because there won't be that time to dilly-dally, you can see that our answer is B. Okay, 49,217, which is this one, is the non-current liability, and this one. And by elimination, you can see that there is no any other. I mean, of course, A can hoodwink you if you haven't made the ACCA tutor today or or before the examination. Then you are going to fall prey to A, because A was there to just dazzle you, to just throw you overboard. So please stay closer to the ACCA tutor. So let us verify the difference there between 93,391 and 49,271, and you can see that that's the current liability. So it's very, very, very simple. It's very simple. These things are very interesting. If somebody says, "I know I hate accounting," you must tell them that, hey, come to the ACCA tutor and your problems will be solved. Okay, we have got that cleansing spirit, that holy one, that can wash you away from the demons of failing. Okay, now this is the computational table. All right, we have been dealing with this part. All right, and I say that you need to, like, the start of the year is 1st January 20x1. Okay, so we have got our opening liability, which is increased by the interest, but is going to be reduced by the installment. Okay, the installment in arrears. All right, and we come to the the closing liability for that particular year. But if we want to do our financials, we then have to extend with another year. We subject this balance with to an interest charge, and we reduce again that one with the installment for that future year, and we have got a closing non-current liability, which is the XB, is the non-current liability, and the current liability is going to be this one, closing balance for the current year, and the future year. The difference there is going to be this one, the current liability, and you are done. You pass your ACCA. Are we together? Right now, for the situation where we are having installments paid at the start of the year, okay, we compute our lease liability as usual. All right, and we we are going to our lease liability. The first lease liability would have been reduced, okay, would have been reduced by the first installment. Remember, okay, the first installment which we make would have reduced the lease liability. All right, so there's no way in the first year you are going to charge again or to deduct again the the annual installment, because your first installment is actually something that would have adjusted your lease liability. So this is why on this table you're not seeing in the first year, you're not seeing the annual installment. All right, that one has been understood. Then after you have adjusted your your annual payment to the lease liability, you then subject it to the interest charge, all right, which will give you the balancing, all right, the closing balance for that year. Then at the start of the second year now, we have our installment recorded, all right, and uh, this is now going to lead you to the closing balance. So at the start of year 2, you will see that we'll be having on 1st January, we'll be having the closing lease liability, which is going to be, as usual, the non-current liability. All right, but for the current liability, you will do the same thing as the closing was the balance which was there yesterday before we pay the installment, all right, and versus the balance after paying the installment, all right. So in essence, the current liability in an advance situation is actually the lease, the annual, the annual installment. The annual installment is our current liability. Okay. And somebody say, here now, I'm lost. Just remember, just memorize that if installments are being paid in advance, the current liability is the installment amount. That's the current liability. You are home and dry, and you pass your MCQ question. Okay, I don't know if I have an example on that, but no, I don't think I have an advanced example. I'll do that one maybe for those ones who are writing in June. Okay. For now, maybe in mock 2, in the mock 2 debrief, if I find one, if I find any question there, then I'll do that one. Now, for argument 2, what would be charged to profit or loss for the quarter ended 31st March 20x5? So we are looking for the profit or loss charge. So let's go to argument number 2. This 9-month lease, the 9-month lease relates to a van. So these are leases for smaller amounts, or maybe low value leases. Okay, usually IFRS 16 allows us to expense whatever lease payments we'll be doing. Okay, so they are expensed as incurred. They're expensed in the year in which they relate to. Okay, so the fair value of the van is 120,000 and it has an estimated useful life of 5 years. Okay, but for our purpose, it's a 9-month lease. So you can see that a lease could, the underlying asset could have a useful life of many years, but you are allowed to enter into a 3-month lease in relation to that asset. It doesn't matter. What matters is the treatment of your lease term. If it is a 3-month lease, okay, and the value is so trivial, so you just have to expense. Okay, it's a short-term lease, just have to expense it. 3 months, 9-month leases, just expense them, okay, to the statement of profit or loss. So the agreement requires block score to make no payment in month 1 and 4,800 per month in month 2 to 9. So the first month is free. Okay, so we are paying how much here? 4,800 multiplied by how many months? According to the list, we are paying for 8 months. How much is this? You know, in the examination, just try to make sense. Okay, just love working out this thing. 4,800 multiplied by 8, we are looking at 38,400. Okay, that's the amount, right? That's the amount we are looking at. Now, don't tell me 30,000 isn't it some big money, so why are you saying this is a low value list? It's low value at international platforms, you know. It's low value. Okay, Vans, that's low value. Okay, I'm looking for my question. Where is question? Yeah, this is the question. So what would be charged to profit or loss for the quarter ended 31st March 20x5? So we have started this list. We have entered this list when? Okay, because so we ended on 1 January 20x5. So we are now comfortable now to see, okay, fine. We are told that we are not going to be charged for the first year, for the first month. Okay, for the first month, we are not going to be charged. So in January, we are not going to be charged. All right, so we'll be charged February, March, only 2 months. Is that clear? Am I talking to somebody? Okay. Are we together, guys? Are we together? Have we tried to come up? We are told that there is a month we are not going to pay. We are only going to pay 8 months for 8 months, even if this is a 9-month lease. All right. So the question now is saying that I'm trying to move my case. Okay. The question is saying that although we have discovered that we are going to pay 38,400 in total throughout the list, I think that's the value which we obtained. That is 4,800 multiplied by 8 months. That's 38,400. Okay. We are now being required to account for only a quarter, but we know that a quarter is okay, 25% of 12 months, right? That's another way of getting a quarter. What is 25% of 12 months? This should be 3 months, isn't it? May determine 25% of 12. Yes, that's 3. Okay, why did I use 25%? Because we know that a quarter is 1/4. All right, and 25% is 25 over 100. So if we solve 25 into 25, 25 into 100, that's 4. Okay, so a quarter is just a period of 3 months. That's 1/4 multiplied by 12 months in a year, and we are going to get 3 months. Most people confuse a quarter and say, a quarter of a year, they think it's 4 months. It's not 4 months, it's 3 months. So they are now, the examiner is now saying, so for 3 months, how much shall we expense? So we divide the total amount by 3 and we get 38,400 divided by 3, that's 12,800. That's the amount we need to expense to the statement of profit or loss. Okay, somebody was saying, or is saying, or could be saying, why are we not just charging for the first 3 months? Because the first month we are not going to be charged, so it means that we are only going to pay 4,800 plus 4,800. This means we are going to pay 9,600. This is wrong because we are not doing cash accounting. We are doing accrual accounting. Okay, we are doing accrual accounting. So the total lease cost has to be put into perspective. Okay, the total lease cost is going to be expensed evenly. All right, we evenly account for the total lease cost. All right, and then each quarter we then have to consider it as 3 months, full 3 months, regardless of the fact that the first month we're not going to pay, but in a substance we're going to pay for it. All right, we're going to pay for it, although the payment has been reduced, but we are going to pay for it. Okay, so that's 12.8. That's the answer. Do you still have a question on this part? Question 7. For argument 3, what profit should be recognized for the year ended 31st December 20x5 as a result of the sale and leaseback? And remember, this is the profit on rights, profit on rights transferred. Always remember this. So the first thing we are going to do, we're going to determine the lease liability. All right, compute the lease liability. Then we compute the row, okay, which is the PV over PV of lease liability. So which means this amount we're going to use it on the numerator over the FV multiplied by the carrying amount of the assets. All right, then once we do that, we get the total gain. Then from there we get the gain on rights retained, right of use retained. Then we move on to the gain we want on rights transferred. So let us try to get the information and slot in the figures. This sale and leaseback relates to a cutting machine purchased by Blocks Co. on 1 January 20x4 for $300,000. The carrying amount of the machine as at 31st December 20x4 was this much. So the previous year, the closing books were showing that the carrying amount was 250,000. On 1st of January, when they entered into the contract, it was sold for 370, which is close to the fair value, right? And Blockscore will lease the machine back for 5 years. All right, for 5 years, the remainder of its useful life at 80,000 per annum. So these are the lease rentals or the payments. No, those are not the payments. They're saying that it was sold to Cogs Co for 370,000 being the fair value, and Block Co will list the machine back for 5 years, the remainder of its full life. All right, this is the remainder of its full life. All right, at 80,000 per annum. The present value, all right, yes. So these are the annual lease payments. Okay, the annual lease payments, and then the present value of the annual payments is 350. So the examiner has calculated the lease liability for us. The transaction satisfies if it's 15 criteria to be recognized as a sale. So we are home and dry. We now have our LL. Okay, we can solve this even here. We've got our LL, the lease liability, which is the first stage. We have got this is 350,000. All right, because so to calculate the row should be the 350, which is the present value of lease payments, divided by the fair value of 370,000 multiplied by the carrying amount. The carrying amount of the machine was 250. Are we seeing this, ladies and gentlemen? Or maybe the pen is not clear enough, or maybe let me just try to use a much darker one. Okay, so we have got these figures. Let's compute the row. The row before. Maybe that part of the screen is not visible because of maybe. All right, so we are saying let's punch the figure. That's 350,000 over 370. Okay, multiply by 250. So we can see that we are looking at 236,486 as our row. Okay, 236,486 is our row. All right, now let us come to, so our row, we are simply saying we have found 236,486. So what is the total gain? The total gain, we say that this is fair value less carrying amount. So the fair value, according to the question, has been how much were they given? They were given 370. Okay, so that's 370. All right, sorry for going back and forth. So 370,000 minus the carrying amount was sorry again, the carrying amount was 250. Okay, 250, sorry, so 250,000. So this means the overall gain 370 minus 250, that's 120,000. So what about the gain retained? Gain retained, that's 120,000 multiplied by the present value over fair value of the asset, and the present value, as we have seen, was 350. Okay, it has been calculated by the examiner for us. The examiner told us that this is 350, right? The present value of annual lease payments, 350. Okay, so that's 350. So that's 350 over the fair value, and with the fair value is the same as this one, that's 370. So 370. Okay, 350 over 370 multiplied by 120. 370 multiplied by 120,000. So we can see that the value retained, the gain on right retained is 113,513. Okay, somebody, I mean, it can be 514. So somebody who is tired, who has not been coached by the ACCA tutor, will quickly run to pick this amount. They will pick this amount and fail the exam. They will rush to pick that amount and fail the exam. The exam wants you to pick the gains on the right of use transferred. Let me just look for the proper wording. Okay, the proper wording according to the first question, because that one gives us the proper wording. You need to recognize the proportion relating to the right of use transferred. So that's the type of gain. That's the gain you need to recognize, you guys. I'm sorry to take you back, but sometimes I find it necessary to just try to ensure some consistency in the way I teach. So once you have done that, once you have found the gain on rights retained, then you then compute the gain on the right of use transferred, which is the total gain of 120, total gain of 120,000 minus the gain on rights retained of 113,514. And what do you get? 6,486. Very few candidates found this correctly. So this is the rightful answer. That's the rightful answer, ladies and gentlemen. And if you want to pass this examination, please replay this video. Replay over and over. Replay it over and over. Right? Over. I'm saying over and over. Thank you so much. I think we need to dedicate the section C to the other part of the video. Shall we continue? Okay. Others are saying, oh, please, let's continue. Let's continue. So for part C, we picked a past exam question, which we put as a mock, but we give credit to the ACCA for, making those questions accessible in the public domain, which is something good practice that's giving back to the community so that the accountant's profession benefits. So I'm discarding all the workings. Okay, they're no longer necessary. Let me try to locate the question which we want to use. Okay, don't I have a PDF version of the question? The PDF version of the question, so that I can use navigate using the pens. Oh, the computer is sticking. Ladies and gentlemen, just allow me just a little bit of some time as I put my machine on the, it's sticking. Okay, ladies and gentlemen, we are having a section C type question, which was part of our mock revision exercise. So we're going to just run through and discuss the main points which could be of assistance to you in your upcoming ACCA financial reporting examination. Okay, so by using a past exam question, we are trying to give you the chance to get or to gain the feel of the actual ACCA examination. But one thing for sure, this is not going to be an easy or a walkover examination, but it is also possible that you can pass it just like anybody. Okay, so do not fear, do not panic. All right, this is a computer-based examination, which means you need to get, to get used to the use of digital platforms in solving or answering these questions, like the use of Excel and so forth. Because you're not going to be given a physical question paper. This one is now obvious. It's been something that has been happening for nearly a decade now, that examinations are now being held online and through the use of proctoring software, that you're not going to have a chance of cheating. If you do so, you'll be disqualified. Okay, so everything will be done online. So I encourage you guys to just use whatever uh, platform, be it a word processor or an Excel that is going to be marked. Do not spend much of your time on the scratch pad trying to write some notes and so forth. You'll be wasting much of your time. Whatever you want to write it on the Excel sheet, on the spreadsheet, or on the word processor that is given to answer the question. There won't be any time to do some drawings, to do anything that is not necessary. Okay, time is very important in the examination, and you just have to be on fire, just have to be moving as fast as possible. All right, so we are given the financial statements, the trial balance of Mims company for the year ended 31st December 20x5. All right, on a trial balance, we have got two things. We have got this is where's the pen? Let me look for the pen. I'm sorry, I can't find the pen. What's going on? Okay, so for that, I need a pen. All right. So we are going to have the debit and the credit columns. All right. We covered these issues, but I found that they are of significance to be discussed about to students. All right. Somebody, like for example, you need to interpret what it means to have a debit balance of income tax. You need to be able to interpret that. Otherwise, if you simply just say, okay, fine, it is on the debit and this is on the credit, and move on, you are going to fail. Sometimes the examiner might give you, for example, sometimes the retained earnings themselves could be in the debit. Then you would as well see that this particular company, if they are having a debit balance in the retained earnings, it means that they are a loss maker. They've been in losses forever and ever. They have got retained losses. If we have got the income tax of 140 in the debit, it simply means that previously they had underprovided for their income tax, which means in this current year they have to tax that. It is part of the tax expense for the current year. So all those things need to be understood by a student who is ready to sit for an examination. So you are going to be given, in section C, you are going to be given a very long question, okay, but not that long, because in SBR this will be times 2 or times 3. Okay, so in ACCA financial reporting paper, you'll be given the financials. In section C, you're going to be given a long question similar to this one. Okay, so the question will be having some additional information. Okay, apart from the maybe the financials or the trial balance you'll be given some relevant additional information. So, for example, here we have got notes 1 up to, if you scroll down, if you continue to scroll down, up to 7. So 7 notes, and you must dedicate at least a minute or 2 per note. In the examination, when you'll be reading the notes, okay, when you'll be reading the notes, you should be doing the workings. Okay, there's no time for you to read the notes, the whole question, and then you start to attempt to do the workings later. There won't be such a time, because to read the question itself would need at least 5 to 10 minutes, which will be wasted for nothing. All right, because unless you write something, you're not going to get a mark. So whatever you'll be reading, make sure you will be doing some. You should have to. You should be writing somewhere something on the platform or on the position where a mark could be secured. That is, do not waste time on the scratch pad. That one is not going to be seen by the examiner. Okay, so you'll be wasting much of time. Write everything, anything, any nonsense on the word processor or on the Excel sheet that is going to be given or that is going to be found on the question. Just write something, because the examiners are going to see that. If you waste your time writing your nonsense where the examiner is not going to see them, you will be wasting much of your time. All right, good. So the first requirement is saying prepare a statement of profit or loss for Mims, and this is 12 marks. All right, so for you to prepare the statement of profit or loss when you are given a trial balance, it means you need to be then be organized and understand the double entry. First of all, you also need to have an idea of the statement of profit or loss. All right, one thing I liked about this question is that after the statement of profit or loss requirement, you are also going to prepare a statement of changes in equity. So those are related. So those 17 marks, even if your figures are going to be wrong, if you find wrong figures here, it doesn't mean that you're going to be penalized here. So if you stick to your figures, because examiners, they just want you to be, to be somebody who's decided. Okay, you have found the wrong retained earnings or wrong profit figure, but if you extract that profit for the year into the correct column in the statement of changes in equity under the retained earnings, then you're not going to be penalized. You're not going to be penalized twice for a wrong figure. Okay, they're going to give you the marks. So this is the thing, ladies and gentlemen. You just have to. This paper can be passed by anybody. So without much ado, we've got our trial balance, ladies and gentlemen. The revenue, we know it is on the credit. That one is obvious, and the costs and the assets. The debits, ladies and gentlemen. Debits. The debits are for costs, assets, costs and assets, expenses, right? The assets, all those things, they are recognized in the debit. And the credit, these ones, we are talking of revenue. We're also talking of liabilities. We're also talking of incomes. Okay? All those ones, we did cover those things previously in our previous papers. So here it is considered that you now know, you are now an adult. Okay, you're now an adult. So these things like suspense accounts, they shouldn't scare you like sending a chill in your spine. No. Be steady, right? So let us attack the notes, because these are the workings or adjustments to the figures given. Okay, because we are told that's relevant information. So there could be some adjustments or some more information which the users of financial statements should know. All right. Mims company noted there was an error in the inventory count at 31st December 2024. Okay, so when you see a debt, tell yourself or ask yourself, when are these financials prepared, or are for which financial year? So if you come back to the question requirement, you are being asked to prepare the statement of profit or loss for the year ended 31st December 2025. So this error in question, is it a current year error or it's a prior year error? You can see that it is referring to 31st December 2024. So this one is a prior year error. And prior year errors are treated prospectively. Okay? They are treated prospectively. We just make an adjustment for that error and move on. We're not going to correct whatever, everything that was done before that error and so forth. No. We just start from the error and go forward. Okay? So, we are saying, the examiner is saying, meaning that the closing inventory balance in the 2084 financial statements was overstated by 0.7 million. No entries have yet been made to correct this error. So, what was happening? All right. Okay. Or what was the impact of this error? It means that the retained earnings were overstated. Okay. And inventory as well. Inventory was also overstated. All right. The profits were actually overstated, and the inventory was also overstated. So which means the opening inventory balances and the opening retained earnings balances have to be reduced. Okay, so what is the correct double entry to correct the position, to correct the prior year error? We need to debit something here. All right, we need to debit the retained earnings. All right, by how much? By 0.7 million. This is if we are debiting retained earnings, like I said, ladies and gentlemen, retained earnings by nature, these retained earnings are credits. Okay, they follow the revenues, the what side, the liability side, and so forth. All right, so they are by nature credit entries, but we need to debit them so that we reduce them. Okay, so you must write this entry. You just say note number 1, okay, because just do your notes in line with the notes as per the question, so that you won't be lost along the way. So note number 1, debit retained earnings 0.7 million. Okay, your note should be in thousands. Okay, tell the examiner my notes are in thousands, so that they know the current value or the value of your figures. Otherwise, some examiner who is very strict is going to be annoyed by that reluctance, and you'll be penalized. So you must avoid all silly mistakes at all costs. Okay, avoid them at all costs. Now, we are going to credit something. What are we crediting? We have been told that the inventory is what is overstated. But now, we need to reduce the inventory. Okay, we need to what? To reduce the inventory. What do we do? Okay, I want you to appreciate one thing, ladies and gentlemen, that if we are talking of closing inventory, we are almost close. We are actually close. We are actually playing in an account called cost of sales. That's where we find this closing inventory issue. Okay, so if closing inventory is high, if the inventory or closing stock or closing inventory, all right, if closing inventory is high or is going up, it means the cost of sales will be reduced. Okay, the moment our closing inventory is increasing, it means also that our cost of sales in total is going to be reduced. All right, and if closing inventory is going down, the cost of sales will be increasing. All right. So if cost of sales are increasing, it also means the profits are reducing. Okay? But in this case, the closing inventory was high. Okay? The closing inventory was high, which means if the closing inventory was high, it means the cost of sales was uh, small, right? The cost of sales was small, and in this case, the profits were actually, more profits were made, but it was wrong. So something now should be addressed, all right? Or there should be some reversal. But we need to understand what was the movement in double entry, okay? The debit. What was the original debit or credit? Were there more debits or were there more credits initially? So for the retained earnings, we discovered that there were more credits. Okay? We discovered that there were what? There were more credits. So which means there were also more debits of something. In this case, there were more debits of the cost of sales. Okay? There were more debits of the cost of sales. Why? Okay, I'm looking for a space so that I squeeze my figures so that maybe we can come up to some agreed position. All right, let us think of hypothetical figures. Let's say our sales are $100, okay, and cost of sales, which is made up of opening stock, that is, let's say opening stock is 50, add some purchases, we made some purchases of 60, okay, and we get 110. If we add 50 plus 60, then closing stock here is let's say 80. All right, if the closing stock is 80, then if we deduct it from 110, we get the cost of sales of the ultimate cost of sales becomes 30. Okay, and this is deducted from 100 and we get a profit of 70. Okay, then let's say with the same sales figure of 100, the cost of sales, the opening stock is 250, the purchases is 260. All right, we get 110. And then in this case now, the closing stock, okay, the closing stock has reduced now. If we reduce the closing stock to say 50, all right, closing stock is 50, then you can see that our cost of sales will become 60, and the profit we get will be only 40. So what am I trying to say? If we have got more closing stock, it means the cost of sales. If the closing stock, as you can see on my hypothetical example, if the closing stock was high at 80, we obtained a profit, a gross profit. This is gross profit of 70. Okay? But when the closing stock was reduced, we obtained a gross profit of 40. Are you seeing the logic? So, if the closing stock again is high, the cost of sales is reduced to 30. This is a reduction. But if the closing stock is low, it means the cost of sales is high, is 60. All right? So the situation last year is the first situation where the closing stock was overstated, which means the cost of sales had some extra debits. The cost of sales had some extra debits. So to correct this, we have to put some extra credits. This is why I'm opening a credit entry there. So we need to credit cost of sales by the same amount of 0.7 meters. Million. $0.7 million. Do you get the idea, ladies and gentlemen? This is why we need that double entry. Okay, please replay this part of the video because I'm going to delete some of the issues there so that I also do the workings for the other notes. But like I said, you need to be writing this journal. Like for example, this journal, you write this journal and tell the examiner to correct. This is to correct the prior year error. Okay, to correct the prior year error. If you write that, the examiner is actually going to give you some marks, because you have written something. So if you have written something, you're always going to be rewarded. Well, this is an examination. Are we together? So if you write all those critical points on a scratch pad, the examiner is not going to see your answer, and you'll be wasting much of your time. Good. Let us now look at note number 2. Let us look at note 2. The provision relates to a court case. All right? The provision relates to a court case in existence since December 2024. All right, so somebody might be asking, okay, still on net 1, after you do that double entry, what adjustments should be made? Okay, so you come to cost of sales because we are crediting, obviously. Okay, when you are doing your statement of profit or loss, you will see that the cost of sales would need that's 11,600, which is given here, minus the 700, which we have talking about. Okay, 700, which we have spoken about. 700, which we have spoken about. Okay, 700,000 or 0.7 million. This is, you can as well, write not one, not two, but on Excel, the examiner would see where you have obtained that 700, isn't it? And when you have done your workings, obviously they're not going to penalize you. Okay, so that's the adjustment. We need to reduce the cost of sales. This is why we are crediting cost of sales. We are reducing the cost. Why? Because when we extracted the opening balance, it had some extra debit. It had been understated. All right, the cost of sales had been understated by overstating the what? The inventory. The closing inventory. When the closing inventory was overstated, the cost of sales was reduced. So we need to credit the cost of sales. That is to reduce the cost of sales so that we come to, this current year should benefit. In the previous year, we did not benefit because there were extra costs. Something like that. Okay, so in the current year, we need to benefit. The costs have to be reduced. Okay, the retained earnings figure would also need to be adjusted. So there's a problem in doing the adjustments. From note to adjust note, you end up making some errors along the way because you meet a note that it requires some compound adjustments, and by so doing, you'll be confusing yourself. So do it systematically. Let us finish with the notes, and then we'll come back to the adjustments. Please, I beg of you. Okay. Okay. Please just replay that part of not one. It's very essential. Why we are debiting the retained earnings and crediting the cost of sales. All right. We said that if inventory is overstated, okay, inventory is overstated, the retained earnings are going to be, the retained earnings will be overstated, that is, will be credited. But this was a wrong position. So we need to correct the retained earnings by reducing them. So we are debiting the retained earnings. Then also the cost of sales. Initially, the cost of sales was debited inappropriately. Okay, was because by debiting the cost of sales, we are saying the cost of sales were increased initially, which was wrong. Okay, they were increased. Why? Because when we overstated the inventory, we reduced the cost of sales. All right, so to correct that, we need to remove that extra cost by crediting the cost of sales. I'm not clear. Okay, no more questions on that. Good. All right, now let's go to note 2. The provision relates to a court case. So you go back again to the question and look for the provision. Okay, provision, where are you? Let me tidy up. Let me tidy up this place. Okay, good. If you ask the question, provision, where are you? It will tell you that I'm here. So this is the provision, and it is being written as 4.6 there. So when you see that, you then have to be very, very happy. All right. So the provision on the trial balance is appearing. Yes, it's on the correct column. The liabilities are on the credit side, which is good. So 4.6, all right, that's the value or the carrying amount of the provision in our records. And we are being told it relates to a court case in existence since 2004. Mims company settled this case on 31 December 2005 for 6 million. The full amount was credited correctly to cash, okay, it was corrected to, credited correctly to cash with a corresponding debit entry being made in the suspense account. So what was done was that they debited suspense accounts with how much? 6 million, and credited cash or bank. Okay, they credited cash, that is how much here? 6 million. This is what they did. The full amount was credited cash with corresponding debit entry made in the suspense account. All right. So, but are we happy to just have a suspense account when we know what to do? So in this case, we know that this is a provision account. All right. No need to debit the suspense account. All right. In this case, we just have to debit the provision. By debiting the provision, we are removing the provision. Okay, because we have settled it, isn't it? So we are derecognizing the provision. We need to remove the provision. Are we together? So let us remove that suspense account entry. Okay, so like I'm saying, we need to, okay, we need to okay, the full amount was credited correctly to cash with a corresponding debit entry being made to the suspense account. All right, so the correct position should actually have been to debit the provision, right? Debit provision. All right, but in the provision, we cannot debit the whole 6 million like that. Okay, we need to fragment it, because in the SFP, the balance of the provision according to the trial balance is how much? It's where's the provision? Provision, where are you? Okay, this one. I've marked it. So it's 4.6, right? So in the SFP, it's 4.6 thousand. All right. But now we want it to be 6 million. So it means we also continue to debit provision. But this time we have moved from 4.6 to 6 million, which means this increase, okay, the increase is actually going to be expensed in the statement of profit or loss. So we are debiting the statement of profit or loss with the difference, which is how much? 4.6 minus 6 million, that's 1.4. Then we are also going to credit the suspense account with how much? With 6 million. This is the suspense account. This journal will then ensure that we have cleared the suspense account, no more suspense account, but we have opened the relevant accounting entries. But one thing for certain, if you look at the trial balance, because remember, this is where you are going to construct your statement of financial position, your statement of changes in equity, your statement of profit or loss, whatever the examiner wants you to construct. So be careful or be mindful of the classification of accounts or account classifications. All right, there is you might discover that sometimes provision, okay, to continue, to come up with a statement of profit or loss with an item for provision when we know that the provision has been settled. That type of of confusion is going to it annoys examiners. Okay, it annoys. Yes, of course, in the statement of profit or loss, there was an increase in the provision, in the expense related to the provision, as we have already indicated that one of the, the branches of the provision should relate to the increase, but it is advisable to just slot that figure into the admin expenses. All right? You can indicate not 2 or not 3 or something like that so that the examiners will see. But, that shows that you are now mature. All right? So for now, let us indicate some admin, because by the end of the day, we need to create something that is going to be meaningful. All right? So obviously, this should be an admin expense. We're going to add it to the admin expense. Let's move on. Note 3, the income tax figure in the trial balance relates to the under or over provision from the previous year. All right? And like I said, if it is in the debit column, it shows that there was an under provision. All right? It was an under provision. If it is in the credit, then there was an over provision. Okay? So that is the idea, ladies and gentlemen. That's the idea. Okay. Now, the note goes on to say, the income tax figure in the trial balance relates to the under or over provision from the previous year. The current year tax is estimated to be a tax refund. Okay, so this year we are expecting a tax refund. Okay, so in the mind of somebody who has been through the ACCA tutor would see that a tax refund is, an expectation of a tax refund has got a deferred tax asset implications. Okay, has got a deferred tax asset implications. So that simply means that we are going to, we're going to debit deferred tax asset, how much? 1.2 million. Okay, and credit income tax, or corporate tax, corp tax or income tax is given 1.2. Okay, so if we are crediting corporate tax, we know corporate tax is an expense, but if we are crediting it, we are reducing the expense. Are we together, ladies and gentlemen? We are reducing the tax expense in the statement of profit or loss. This one, the DTA, is actually something that occurs in the statement of financial position. Is that clear? Good. So please be careful. Remember your workings. Remember, I say that you need to number your workings. Okay, this is actually working number 3. Excuse me. The way I wrote my 3 there, it's not pleasing. Okay, that's working number 3, and this one was working number 2. Okay, and this one was working number 1. All right, and number 3, like I said, some of the notes or some of the workings could be having some compound workings. All right, compound workings. So which means you would also need part of working number 3 again, part of working number 3, because it's saying in addition to this, the deferred tax liability at 31st December 2025 is estimated to be 8.2 million. So the closing DTL, is 8.2 million. What about the opening DTL? Opening DTL if we come back to if we come back to the question, if we come back to the information, we can see that there is information about opening DTR, which is 7700. Okay, 7700, 7.7 million. So what's the difference? 8.2 minus 7 pound, that's almost about 0.5 million. So how do you treat this 0.5 million? Okay, you're going to debit corporation tax. Okay, we're going to debit corporation tax because that's an increase in deferred tax liability. So it is an expense. We are increasing tax 0.5 million. So we are debiting it and crediting the DTL, deferred tax liability, of 0.5 million. And the tax being debited here is an expense which affects the statement of profit or loss. The DTL affects the statement of financial position. Okay, so we are dealing with each item step by step, and you can see that this is purely something that is very, very easy. Are we together, ladies and gentlemen? Let's do note number 4. Number 4. On 3rd September 2025, Mims Company made a 144 rights issue. The exercise price was $3.50 per share. The proceeds were correctly accounted for in cash, with a corresponding credit entry being made in the suspense account. So we need to establish how much was the proceeds. So that's working number 4. All right, let me look for another pen. Working 4. Working number 4. Number of shares issued. That's a very important figure. We need the number of shares issued because there was a 144 rights issue, which means 1 share for 4 already held. Okay, those 4 should be the number of shares outstanding or currently with the shareholders. Okay, so we go back to the information about shares. I'm sure we can get that information about shares. Yes, the equity shares. These are priced at a nominal value of $1. So, which means if they are worth $60,000 and they've got a nominal value of $1, it means we have got 60,000 outstanding shares. 60,000 shares which have been previously issued to the shareholders. So 60,000. All right, number of shares already there are 60,000. But we have issued 144. So obviously, the number of shares issued in the rights issue are 15,000 shares. Okay, and what is the market value? The exercise price. The exercise price from the note is $3.50. So we need to multiply this by 350, and we get how much? That's the proceeds. The proceeds from rights issue. The proceeds, that's how much. Let me use my calculator here. 15,000 multiplied by 350. That's 52,000. Sorry, 52,000. No, 52,500 dollars. Okay, 52,500. These are dollar signs. So 52,500. But now you need to then question yourself. 52,500. Who are you? How am I going to account for you? Because the question or the examiner is actually saying, no, these guys rightfully accounted for the cash, but they put the other side of the of the account to the suspense account. All right, so these are proceeds. So what occurred? What was done? What was done? Let me just say what was done. This is what the accountant did. He debited cash. How much? 52,500. That's what he did. And credited suspense account with the same figure, 52,500. That's what he did. But you are now an accountant who has been trained by the ACCA tutor. So you must come up with a, some journal to correct this. Okay, so we need to find something which we need to debit. All right, we need to debit something and credit something. Something has to be debited. So obviously you can see that the debit has to go to the suspense account because we are having a credit suspense account. So obviously we are going to correct this. We are going to debit suspense. This is a correction. Debit suspense account. How much? 52,500. Okay, 52,500. And credit somebody. This time is the share capital. Okay, but the share capital now, because we are told that this was a rights issue. Rights issues are given to existing shareholders. It's given to existing shareholders to prevent issues like dilution of power, or dilution of earnings per share. All right, the dilution of earnings per share. So we want our original shareholders to just keep their shareholding percentages as they are. There is a disadvantage if you do not participate in the rights issue. You are going to suffer to some extent. Your value is going to shrink. Okay, that one is part of the financial management paper. So shareholders are encouraged. The exercise price is likely to be below the market price, but above the nominal price. I mean the nominal value of the share. All right. So in this case, the exercise price was $3.50, but the nominal is $1. So the nominal is likely, is the figure that gives us the share capital or the equity capital value. So let's start with the share capital. So we are going to credit share capital. Share capital. How much now? All right. We have been told that there were 15,000 shares which were issued. 15,000. All right. And the nominal value for the 15,000 share is $1. So the share capital value, the share capital will be 15,000. So we are crediting 15,000. And the balance, okay, the balance is the share premium. The share premium. The share premium. Okay. What is the balance? 52,500 minus 15,000. How much is that? 52,500 minus 15,000. That's 37,500. That's where, guys, these workings are very important. That's where your marks are going to be obtained from. If you do not show these workings to the examiners, you're not going to get any marks. The statement of profit or loss itself might maybe constitute 3 marks or 2. So this is where you get all the marks. Are we together, ladies and gentlemen? Because by the end of the day, after you calculate the proceeds, then you have to lead yourself. How are you going to do the accounting? So those are the double entries, the journals which are required. All right. We have shown you the first journal which the accountant did, but which was wrong, and then gave you the correct journal to be done. Are we together, ladies and gentlemen? Good. So that's it for now. Let's proceed. You need to do these things running. Okay. I'm tidying up the place again because I want you guys to see the note 5 clearly. So please forgive me for rubbing off part of the work. Okay, you just have to replay that part of the video so that you are not going to be left behind. Okay, Mims company acquired an investment property for 20 million cash on 1 January 20x5 and decided to use the fair value model to account for investment properties. Okay, you know, we have got 2 valuation models which we have to choose. There's the cost model and the fair value model. So those are the models which you can use, and they were correct in just deciding that. As the property is expected to have a 20-year useful life, depreciation was recorded on this basis. Now the question is, if you are using, you have already done the right thing. Okay, you have done the right thing. You have chosen the fair value model. But now, why are you, charging depreciation? That's the question. Because if we are using the fair value model, it means there's not going to be any depreciation. We are going to move, any variation in fair values or any movement in fair values is going to be a gain or a loss. So any movement, any increase or decrease is going to be expensed or to be accrued to the statement of profit or loss as appropriate, isn't it? So in this case, they deviated from the principle, they charged depreciation. All right, excuse me. So let's talk of the depreciation charge which they did. All right. Okay. So obviously on the initially what they did correctly, right? So they debited investment property 20 million, which was good, and credited the bank. All right, 20 million. It's essential. This was correct. However, now end of year now. At the end of year, somebody maybe a little bit drunk, somebody a little bit drunk, then charged depreciation. So how much depreciation was charged? Okay, so there was a debit. Okay, this is wrong, but we need to know the wrong that was done, isn't it? So wrong, they charged depreciation, debit depreciation. How much? 20 million, which was the cost over the useful life of 20 years. So the depreciation charge was 1,000. Okay, $1,000, and this was accumulated into the accumulated depreciation account. Okay, 1,000 as well. All right, and The fair value of the property at 31 December 2025 has been assessed to, assessed at 2 million, but no accounting has taken place in relation to this. All depreciation and amortization is charged on a pro rata basis to admin expenses. All right, everything has to be charged to the admin expenses, we are told by the examiner. So what are we going to do? Okay, we need to reverse this. Let's first reverse this. Okay, we are going to debit. All right, we are going to debit okay, we are debiting the accumulated depreciation account 1000 because we want to reverse. Okay, and then we are also crediting the depreciation account. But remember, we are told that this is in admin expenses. So we are going to credit the admin expenses, which means we'll be reducing the admin expenses by how much? By 1000. The last part of this, just to have enough space somewhere. Yes. The last part of this working should be dedicated to the aspect to do with the fair value movement. Okay, fair value adjustment. Because we are told that it moved from 20 million to 22 million at 31 December. So there was an appreciation of 2 million, okay, which is $2,000. So how are we going to account for this? We are going to debit investment property. The investment property is going to be debited with 2,000, and we credit investment income. Investment income, $2,000. Remember, these adjustments as they will help you to find the figures to slot in your statement of profit or loss. Remember, the investment income here is a statement of profit or loss item, while this debit is a statement of financial position item. Okay, know your statement of profit items. This one, the admin here we talked about, is a statement of profit and loss item. Okay, and you find them as we go. All right, we're almost through. Now, Mims Company, working number 6. Mims Company incurred a number of expenses in relation to brands during the year and has capitalized the following costs as intangible assets. So all these have been capitalized. So your work is to determine if the capitalization was correct. If it wasn't correct, you then state what was wrong and do the corrections. So let's start with the 1.3. 1.3 million cash was paid on 1st April 2085 to promote one of its major brands, which is deemed to have an indefinite life. Now the question that has to be asked is promotion capital expenditure or revenue expenditure? Because in intangible assets, that's the question that matter in IS 38. All right. So the nature of the promotion exercise on the brands, because they wanted the brands to be known, was it a capital expenditure or a revenue expenditure? Was it supposed to be capitalized as an intangible asset? That's the question. Promotion costs are revenue in nature. Okay, these ones are revenue in nature. Okay, so you tell the examiner, working number 6, working 6, promotion expenses are revenue in nature and therefore can't be capitalized. So what they did, these guys, they had what? What did they do? Because you need to tell the examiner what they did, the double entry which they did. Okay, so what they did was they had, let me just say what they did. They had debited intangible assets with 1.3 million and credited the bank because they had indicated some, monies or funds had been utilized. So they credited the bank 1.3 million. But this was wrong. So you must tell the examiner correction. To correct this, we need to debit promotion expense, statement of profit or loss. Okay, how much? 1.3 million. And credit. We want to credit the intangible assets. 1.3 million. Okay, the assumption is that the bank had been credited properly, which is good. Okay, for the bank, in crediting bank, they were correct, but in debiting intangible assets, they were wrong. So we need to correct that. Isn't it so, ladies and gentlemen? Yes. Okay, let's move on. Part 2 of the same note. 2 million cash was paid on 1 October 2025 to acquire a brand from one of its competitors. Mims company expects the brand to have a useful life of 5 years. Mims company intends to sell it after 5 years. At the point of sale, it is estimated that the value of the brand will have increased, and so no amortization has been accounted for in the current year. So that's another head scratcher we need to deal with. Okay, we need to deal with that because it's actually something typical. Okay, so there's been a procurement of a new brand from a competitor. Okay, and we expect this brand to have a useful life. Okay, we didn't deal with depreciation effects on item 1 because the asset had an indefinite life, so we don't charge an amortization, but we subject the asset, okay, to we subject it to an annual impairment review, something like that. Okay, so that's it for now. This one now has got a useful life that is known. Okay, so we need to subject it to some amortization. Okay, so but before we do that, we need to account for the transaction initially. So what they did initially, they debit intangible assets 2 million, okay, and credited bank. This is very important when we do some of the transactions, or when we will be answering the questions or the requirements. We will discover that these journals will be very, very useful. So 2 million there. Of course, you need to be consistent. If your figures are in thousands, therefore, all those figures which are in millions should be turned to thousands altogether, depending on your basis, all right, valuation basis. So initially, I indicated that all my notes are in thousands, so therefore I should have been consistent as well. I'm sorry for that. Okay, now these guys, they made something a blunder here. They did not account for amortization because they felt that the brand will increase in value and no amortization will be necessary, which was wrong. So we then have to do the amortization required. Amortization required, we are told that this brand will be there for 5 years, and it has been acquired for 2 million, so that's 2,000 over 4. Okay, but we paid this on 1 October 2005, and our year end is 31st December. So we are going to be how many months here? October, November, December. That's 3 months. So by 3, okay, by 3 over 12, because it's 3 over 12 months. That's 3 months, isn't it? So it's for 3 months only in a year. Remember, the depreciation charge or the amortization charge is for the whole year, but we only want for 3 months. So this would give us something like how much here? They're saying 2,000. Okay. This is over 5 years, isn't it? I'm sorry then. That's 5 years. So this is should be 5 years. So 2,000 over 5. This gives us 400. Okay, 400 every year, but for 3 months, this means that we only have to charge $100. So what's the double entry required? We're going to debit amortization, but we were told by note number 5 that all amortizations and depreciations are going to be admin expenses. Are we together? So we are going to debit admin expenses, $100, and credit accumulated amortization. Okay, the admin expenses, these are part of the statement of profit or loss. All right, so we'll be increasing that amount. It's quite hectic, isn't it? Now we are on the last part, ladies and gentlemen. You can pause the video and have a sip because you might faint, isn't it? Okay, Mims company paid a dividend of $0.04 per share on all existing shares 31st December 2005, recording the dividend paid in administrative expenses. Now, we all know that dividends are transactions between equity participants. They should be given out of retained earnings. Okay, if the entity was a sole proprietorship, these should have been accounted for as drawings. So there was a misposting of this, or the misapplication of the accounting standards. So in this case, we then need, okay, let us first of all record what they did. I mean, what was done. First of all, they debited, okay, they debited admin expense. Okay, they debited admin expense with how much? Okay, let us do the computations. 0.04 multiplied by the number of shares. How many shares? Okay, remember we had originally 60,000 shares, but we issued 15,000 shares. So we are now having 0.04 multiplied by 75,000 shares. And this should give us something like $3,000. Okay, so this was the expense, which was expense to the admin expense, and they credited what? They credited the bank because they paid, as they said, this was dividend what? Paid 3,000. That was wrong. You must highlight to the examiner this was wrong, and you then give him the correction. Mr. Examiner, this is the correction. Okay, this is what the correction. So what is the correction? We're going to to debit dividend paid. Debit dividend paid. In this case, you just have to indicate the retained earnings. The dividends are paid in the retained earnings, and we know the retained earnings, we meet it in the statement of changes in equity, where we'll be showing all these appropriations. So the dividend paid, we're going to debit the retained earnings because that's the account that pays dividends. So we are going to reduce that account accordingly with $3,000. And what are we going to credit? We are going to credit the wrong arm, the admin expense. So we are going to credit admin expense so that we reduce it. So the admin expenses has to be reduced by 3,000. This is the statement of profit or loss, remember, SPL. Okay, whereas the retained earnings there, we are talking of the SOC, statement of changes in equity, or the statement of financial position. But it's not, don't worry for now, we'll touch these issues as we proceed. Okay, so I've done the workings now. What's now important is then to be very systematic, item by item, to remember. You must have a good memory, okay? You must not be hoodwinked, because in the exam, you might, this is why I say that you need to write all this on a paper that is going to be, I mean, on the appropriate script, be it the word processor or in Excel, that is going to be marked by the examiner. If the examiner has seen you done this, already you have passed. I mean, out of 12, you are having your 8 marks already. Already you are having your 8 marks, and maybe the 4 marks will be dedicated to the statement of profit or loss itself. So do not worry. Do your workings on the Excel sheet provided. All right. What else must I do? think I need to drink some water. Anyway, let us do the statement of profit or loss together, and then maybe we might know the rest of the question. Is that it, guys? Shit up, isn't it? Good. Okay, fine. What must I do here? Think. Let me try to open some Excel sheets, because to do this without an Excel sheet is going to be a problem. Okay, what's going on? Sorry to take much of your time, guys. I'm trying to open an Excel sheet. Okay, my computer is very slow. Oh, look what's happening now. We are trying to open a new sheet, but something is popping up. Okay, if we have been doing all of these on the Excel sheet, our work was going to be, less daunting. Anyway, we must learn to cope with pressure. I want you guys to see the formulas as we do the computations. Okay, and it's an old computer, so sometimes it won't perform the way we want it to. So bear with us, ladies and gentlemen. Bear with us as we do the computations. All right, so the question wants us to prepare Mims code, right? So you indicate to the examiner this is question number. If it is 31, just say 31. If it is 32, it's okay. Question 32. Then you come, you say here A, part A. What's going on? Okay. Statement. What's going on? It's refusing to allow me to proceed. Okay. Statements of profits or loss. Okay, it can be as well, there's a Mims call, Mims company. Statement of profit or loss. Okay. For the year ended 31st December 20x5. Okay. Can as well, bolden. Okay, if you have the time, but in the examination, you're not going to get any marks for any formatting. Okay, so it's good business, it's good practice to do so, right? So then after that, you come here and um, can indicate to the examiner these are in thousands. My machine is misbehaving. All right, so we can do the formatting, because sometimes okay, it's so that you guys will see it properly. Okay, so being a statement of profit or loss, we start with the revenue, and the examiner has been very generous. There hasn't been any adjustment related to revenue. I think I am correct there. We have never done an adjustment related to revenue, so just pick the figure as it is. That's 24. The machine is misbehaving now, but don't know what's going on. Okay, 24,300. Then the cost of sales, guys, what's going on? Okay, I think let me just cut the video and pause a bit, because the machine is now not responding properly. Okay, I'm sorry for that. I'll continue in another video. Thank you.